and we will start the presentation.
Yes, audible.
Market has seen strong bounce back. When Russia-Ukraine war came, we fell very sharply along with global markets, but bounce back also equally very strong. It is a bit surprising to many of them, especially those who are in the markets for last 20 years, 30 years. They were very much surprised by the bounce back because whatever news flows we are getting globally, it was negative. Foreign institutional investors were selling heavily. US interest rates were going up. US bond yields were going up. Extremely hawkish comments from US Fed. But still, our markets managed to bounce back. The main reason for it is mainly because of strong domestic flows. Our domestic flows was exceedingly strong in the month of March. That is just ended month. We had almost 28,000 crores worth of mutual fund inflows into equity schemes alone. Apart from that, many domestic retail investors were directly buying shares. We are having record account openings. So the domestic flows has supported the market very well, which led to strong bounce back. Also, the whatever macro data we are getting for the last 2 weeks, 3 weeks from the domestic side is exceedingly strong. If you take GST collections, if you take overall tax collections, exports data, they are very positive. So overall, the domestic macro data are positive. Domestic liquidity is very strong, which led to strong market. And we are seeing stock and sector specific action. Mid and small caps are in limelight, and many mid and small caps are going up very sharply. And theme wise also, many individual themes were playing out. And if you see in the last 1 week, the defense theme is doing very well. And we expect more such theme-based action to happen in coming weeks. Globally, if you see, Fed has hiked the rate after 3 years. In 2019 was the last hike, US Fed hike rate. After that, they reduced rate drastically due to COVID. Now again, they have started increasing the rate. We expect that US Fed will keep on hiking rates in the next meetings, in coming meetings. What it is expected is that in coming meeting, the hike will be higher than what it happened last time. Last time, they hiked 25 basis points. It is expected that they may hike by 50 basis points. So overall, it's a very strong market. The bounce back was very strong from Russia-Ukraine correction or war correction. And let us see, now the result season will start coming in from next week onwards. We have to see how the market reacts. And in the last 1 month, if you see, Nifty and Sensex has overall gained around 7%, whereas mid cap and small cap, it has gained around 10%. So one of the main reasons for the market to bounce back, I will tell, is the liquidity. For a market to do well, 2 things are very important. Just like how human beings, we stand on 2 legs. For market to stand, 2 important things, 2 legs are needed. One is the fundamentals. The next one is the liquidity. Without this, market cannot stand. Even if one of the leg goes down, then the market balance, we will lose out. Fundamentals, we are seeing that the domestic fundamentals are recovering because of a huge government stimulus. It is coming out positively. Globally, some things are little volatile, mainly from the US and European unions. Things are little volatile. We are expecting US, there is a possibility of US going into recession next week. Bond markets are indicating it, but still more data has to be studied. In coming days, we will come to know. Whereas domestically, things are looking good. And if you see the flows, it has been exceedingly strong. If you see the yesterday's data of AMFI release of mutual fund inflows, almost 28,500 crores inflow has come into domestic equity mutual funds. So it is one of the highest, at least in the last 4 years, this is the highest monthly inflow, and more money is going into exchange traded funds, and all a large cap, mid cap, small cap, across the board, monies are is coming into it. What is very surprising is that if market correction comes, more inflows are coming into equity. But this is not the case we have seen previously. Historically, if you see in India, whenever sharp correction comes, retail used to get panic and they take out money from the market. But the reverse is happening. Whenever there is a sharp correction in the market, then equity inflows are getting more and more, and more people are willing to buy on correction. So it's a healthy thing to happen, because previously what used to happen is that our markets were entirely dependent on foreign flows. Whenever foreign flows goes out, then our market used to fall very sharply. Now the foreign outflow is entirely balanced by domestic flows, which is good for markets, because volatility will come down because of balancing flows. The volatility will come down over a period of time, which is a healthy sign according to me. So this is the mutual fund inflows, and you can easily see that in the last month we have got almost 28,500 crores inflow. It's a record monthly inflow as far as if you see the recent history. And this is the tax collection, which was released by our government yesterday. And if you see that the tax collection trend has been exceedingly strong. The overall, the direct tax collection has grown up by 49%, indirect taxes by 20%, and total overall tax collection has gone up by 34%, which is more than 30% than what it was budgeted, and it is more than 10% what it was in revised budget estimates. It's a healthy sign. Two things are happening. One is that when economy recovers, more taxes will get collected by the government. That is one part which led to a higher tax collection. The second main thing is that the compliance is increasing. Government is very strict on tax collection, and wherever possible, government is putting checks and balances so that people will come and pay taxes. Wherever possible, government is putting asking people to give their PAN number and other details, so that they could able to track if there is any suspicious transactions which is done to evade tax, and the government is finding it, and because of that fear, many have started paying the taxes, which led to sharp increase in tax collection, which is a good one as far as stock market point of view. And if you see that 21-22 financial year 22, almost 14 lakh crore has been collected, which is highest at least for the last 5 years. Similarly, direct tax collection, it has gone up very sharply. It is almost 20% year on year. It is higher. Overall tax collection is higher by 34%. In spite of very high tax collection, our fiscal deficit is very high. This indicates that government is spending more money, and that is why our economy is seeing sharp bounce back. This is the GST collection, and if you see the GST collection, it has when compared to last year in the month of March, 1,42,000 crores has been collected, whereas in previous month we have collected 1 lakh. Previous year same month 1,23,000 has been collected. Next month the GST collection will be still higher, because the whatever money we have got in the month of March, the government used to show the data 1 month lag. So generally March used to be a highest collection month historically for the government, and next month government will release the GST collection for April, which is actually the tax collected for the month of March. So next month I am expecting almost 1,60,000 to 1,70,000 crores collection for the government. So more GST collection means states will get their share, and central government also will get their share. And if government gets more money, means they will spend more money, which is positive for the economy. The other important thing which is doing very well is the exports data. In the month of March, if you see, overall the exports has been higher by very sharply, and it has touched to 40 billion per month. It is also the all-time highest exports, monthly exports, 40 billion. First time our country has achieved this milestone of 40 billion exports per month, and exports are doing very well. When I talk to industry players also, they are very upbeat on exports, especially those in automobiles, engineering, textiles. These are some of the sectors where exports are doing very well. And it is expected that at least in the near term, exports will do well unless the global economy goes into recession. Exports is expected to do well. Actually, exports has to do well for our country to overall perform. Without exports, our economy cannot grow beyond a certain point. And 40 billion is a good figure. We have generally like a GST collection, the March is generally used to be historically a good month for exports. That is why the exports figure has come to $40. And I'm expecting for the month of April, the exports will be around $35 billion. Maybe month on month, there may be a dip, but still year on year, it will be a decent growth. And this is one company for an example to show that how our exports are doing, why our exports are doing well. This is a company Maruti. Everyone knows that it is a market leader in our country in four-wheeler sales. They have almost 44% market share of total car sales in our country. If 100 cars are sold in our country, means almost 40 to 45% of the total car among them are sold by Maruti. It's a market leader having almost 40 to 45% market share. If you see the sales of Maruti for the last 7 years, from 2015 to 2022, almost 7 years data, if you see it, the total domestic sales is almost stagnant. There has not been a big move. So Maruti has sold 13,65,000 vehicles in just ended financial year FY22. In FY16, if you see, 13,05,000 vehicles they have sold. So just a 3 or 4% jump in the sales in the last 7 years for Maruti. But if you take the export sales for the same company, Maruti, in 2015-16, they have sold 1,23,000 vehicles. Whereas in 2021-22, if you see, they have sold 2,38,000 vehicles. Almost 90% higher than what they have sold in 2016. And if you see, when compared to last year, it is more than 100% jump. So Maruti, if you see that the exports has gone up very sharply, whereas the domestic sales is remained stagnant. That is why the total sales is, in spite of higher overall sales, the domestic sales remain low, whereas the export sales has done very well. And that is the reason why the overall sales has gone up. Like that, if you take any companies, the export sales has been doing well. And if you take a company called Eicher Motor, where they sell Royal Enfield bikes, they have also started doing exports very well. And when compared to the domestic sales, export has started doing well. But the base is very small when compared to Maruti. Maruti export base is little higher than what Eicher Motor does. And many companies exports are doing well, and we expect that the trend will continue, and it's a good for our domestic economy also. When export does well, means overall the economy will do well, and we will get foreign currency, foreign exchange also, because our current account deficit is running very high, and our exports has to do well. And this is the balance of payment. In spite of our exports doing well, the overall trade deficit is very high. Our imports are also very high. And that is why the current account deficit, if you see that, in spite of record exports we have done last quarter, our current account deficit was one of the highest in the last 4 years. 2.7% of current account deficit we have seen in the October, November, December quarter, mainly because our imports also has gone up very sharply. But since export is going up, imports have also gone up. Our current account deficit has risen very sharply to 2.7. Previously, that figure was seen only in September 2018. Right now, our monthly trade deficit is around 18 billion to 20 billion. and entire trade deficit is reflected in the current account deficit, and that is balanced by our capital inflows. Whenever there is a current account deficit, it has to be balanced by capital account inflows. Otherwise, what will happen is that rupee will start weakening, reserves will start coming down. If somebody watching the forex reserves very closely, you can see that for the last 3-4 weeks, our forex reserves have started coming down from around $635 billion. Now it has come to $609 billion of forex reserves, in spite of our exports doing well. The main reason for that is that our capital inflows has slowed down. So whenever we run a high current account deficit, if capital inflow slows, means generally what used to happen, rupee will start depreciating. But in order to avoid rupee depreciating much, RBI has started selling US dollars, which led to reduction in forex reserves. Another big positive in our economy is that the COVID restrictions has been lifted. Now the economic activities are almost at a pre-COVID level, which is very positive, because due to the COVID restriction, many sectors, particularly those in the tourism, travels, and many service sectors were heavily affected in the last 2 years. Now economic activities have come to pre-COVID level, and many governments has removed the restrictions, all the COVID restriction in many states, which led to normal functioning of economy. And tourism and travels are doing very well. Schools have been reopened, and we expect that this will continue. At least we will get another wave. There are talks of a possibility of getting another wave. New variant has come, but what experts are telling that it is not a variant to worry. The symptoms are much milder than Omicron. Omicron itself is a very mild infection, and the recent variant is much milder than Omicron, which means that economy can function as normal at least for the next 3-4 months. So whenever economy comes to normal, means more sectors will do well, and we can see that stocks related to tourism, travels, they are doing well. Stocks in related to hotels and all doing well. Indian hotel has come to multi-year high, the stock prices. The bank credit also has started increasing. It's an important bank credit growth is an important data to watch out for. And if you see the bank credit, it was almost 15% in 2018-19 time. Then when COVID came, it fell sharply to 6%. Now again, it started going up. RBI also in yesterday's policy meet, they told that they are expecting that bank credit to go up, mainly because of two reasons are there. We are also expecting bank credit to go up, and it will be very positive for banks also, because if only when a bank starts lending, they will get higher interest. If there is if the lending is very less, means what will happen is that they will give money to RBI, where they will be getting around 3.5 to 4% interest rate. But if the same money is lended in economy, means they will get around 8 to 10%. So bank credit growth is very positive for the banks, and there are two reasons why the bank credit will go up. The first one is that economy has come into normal, which means that more industry will be in need of money. The second reason why bank credit will go up is that the commodity prices has gone up very sharply. Whenever the commodity prices goes up sharply, means what happens is that the working capital need for the company will go up. Whenever the working capital need go up, means the bank credit also will go up. I will give you one. Last time also I told one example about steel. The same example I will tell now. Suppose if a company which keeps 10 tons of steel as an inventory, when steel price is around 30,000 rupees per dollar, means for 10 tons they may need around 3 crores worth of money. If same steel price goes to 60,000 rupees per dollar, means they may need double the money of what they were actually needed. So the working capital will go up for many companies, for majority of the companies, because to keep the same inventory, they may need higher money, which will lead to higher bank credit. And higher bank credit means more positive for the banks as well as for the economy. Apart from that, one important parameter which I will watch very closely for the next 3 to 6 months is the rupee, because our current account deficit has gone up very sharply, mainly because our imports has gone up. Though our exports has gone up, our imports has gone up. The foreign flows has slowed down. Our capital inflows has slowed down, and we have to watch the rupee, because whatever happened in the economy, it will surely get reflected in the bond market and the foreign currency market first. And we have to watch the rupee closely, because any negative happens in the economy, it will get first reflected in the currency market and bond market. Right now, in spite of Russia-Ukraine war, in spite of crude going above $100, in spite of a huge current account deficit, our rupee has been very strong, relatively very strong when our country faced same type of crisis previously. And now rupee is very resilient, and any weakness comes into rupee means that will start indicating that something wrong is have started in our economy. I will give you one example. In 2011-12, if you see that this arrow mark, 2012 to 13, our rupee weakened significantly from almost 45 to US dollar. It went up to 65 to the US dollar within a period of 1.5 years. The main reason for that just previously 2012, before that, between 2009 and 12, our government in order to rescue the economy from global financial crisis, they gave huge stimulus to the economy. How they gave stimulus to the economy? By running the government with very high fiscal deficit. Whenever government is doing high fiscal deficit, means actually it is giving stimulus to the economy, which led to higher inflation at that time, which led to a high current account deficit, and in turn weak rupee. Crude oil prices also was very high at that time, more than $100. So our import was very high, which led to current account deficit, to huge current account deficit, unmanageable current account deficit, which led to very high inflation as well as weak rupee. The main reason is the government gave huge stimulus to economy between 2008 and 11. Right now, if you see, now also the government has given huge stimulus to our economy in 2020 and 2021 in order to rescue the economy from COVID. And if you see that in 2019, the fiscal deficit was around 4.6. In 2020, it was 9.4, and 2021 around 6.8. The fiscal deficit was. So from 3-4 levels, the fiscal deficit has suddenly gone up very sharply. And if you see in 2010-11-12 period, our fiscal deficit immediate previous 5 years, if you see, it was around 3%, 2%, 4% like that. Suddenly, when global economic crisis came, the fiscal deficit expanded to around 6%, which led to very high inflation in our country, as well as the crude oil was non-supportive at that time. It went above 100, which led to high current account deficit. And at that time, rupee weakened very sharply, and our economy also did very badly at that time. And many of them who were in the market during that time, they will be knowing that our stock market did very badly at that time. And many of the multi-baggers now, at that time, the stock price was trading 1/10 or 1/100 of the price during that period. I still remember that a company called Atul, it was trading around 300 rupees, 400 rupees in 2012-13 period. and that is trading now 10,000 rupees. Actually, we bought that share in our PMS at 400 rupees, but we exceeded around 1,500. In 2 years' time, it went up to 4-5 times. Similarly, many stocks at that time, which were multi-bagger, later multi-bagger, in 2012-13 period, it was down very sharply and market did very badly because rupee weakened very significantly due to huge stimulus given by the government at that time. So I will watch rupee very closely. In spite of stable rupee, we have to watch it very closely. If any negative comes, it will first reflect in the rupee only. If rupee weakens significant limits, then we have to remain cautious in the market. Till now, we can remain optimistic about the market. Oil still around $100. It went around 125, 130 because of the war. Now it is around $100. The main reason why oil fell very sharply is that globally many of the countries have started releasing their oil from their strategic reserves. That led to sharp fall in the crude oil prices as of now. But still, we have to be very watchful on the oil because the main supplier, the Russia supply, has got cut and it has to be replaced by someone else. The strategic reserves releasing may support you for 2 months, 3 months, but beyond that, you have to find other stable sources of oil. Otherwise, again, crude oil will start going up. Now, the Q4 earnings, which will start coming from next week onwards. Monday, we are going to see TCS earnings, and Wednesday, we are going to have Infosys earnings. And next week, only 3 days were market functioning. Thursday and Friday, we are trading holiday. So we have a long weekend next week, and earning season will start with TCS. And last time, what happened was that Q3 earnings was disappointing for many sectors, which led to correction in many sectors. For example, cement sectors corrected very sharply because of poor Q3 earnings. Similarly, FMCG sector corrected very sharply because of poor Q3 earnings. Similarly, like last time, what we are expecting is that during Q4 earnings, many stocks may see correction if the earnings are disappointed. And some of the earnings, what we are expecting from Q4 earnings is that as a sector wise, if you see banks and NBFC, we are expecting to post decent results because most of the banks, the NPA write-off is over. Now interest rate starts going up, which is positive for the banks, and credit growth also started going up. That is also positive for the banks. So banks overall, we are expecting the results to be good. NBFC, the same situation. The lending for many NBFC, the disbursement for many NBFC has gone up very sharply when compared to last year. And the recovery also is very strong, which may lead to good results from NBFC. So banks and NBFC, we are expecting good results. IT sector, it is going to be tricky. What is going to happen is that the revenue is going to be higher than quarter on quarter as well as year on year. But due margin compression, we are going to see. Right now, the economy has opened up, which has led to higher travel expenses. The second thing, those who are working at home, many employees were asked to come into office, which means higher expenditure for the company, and that also will put pressure on the margin. As well as many companies have hiked their salaries for their employees because of huge shortage of the IT workers. That will also affect the margin. So IT sector, the revenue is expected to be higher, but margins will be lower, which may lead to lower profit growth than revenue growth. And it will be interesting to see how the stocks will react because of the IT sector. Right now, the movement in IT sector is very muted, and stocks are very cautiously positioned ahead of the results. The other sectors, FMCG, auto ancillary, all these sectors will see huge margin pressure. Autos, the problem is that there is a semiconductor issue also. Two-wheelers and tractors has done very badly. So the results of this company won't be good. Four-wheelers has done reasonably better. Commercial vehicles has done very good. The four-wheeler car sales has been reasonably good, led by higher exports. So the certain segment of auto will do well, while two-wheelers and tractors will do very badly, as well as they will see huge margin pressure also, because the steel prices has gone up very sharply. Aluminum metal prices that has gone up very sharply, which will put huge margin on the auto companies. FMCG, the same story. The volume growth is going to be very muted. In some cases, it may be negative volume growth also, and margin pressure also we are going to see heavily in FMCG. So the FMCG, the stocks, the results won't be good. In metals, it is going to be a mixer. What is going to happen is that the steel companies may show the quarter-on-quarter dip in profit for current quarter, but from next quarter, their profits will again start going up. And ferrous metals, they will do non-ferrous metal, they will do well. For non-ferrous metal like VADL, Hindalco, and Nalco, these companies will post good profits. Whereas in ferrous case, which is the steel, it is going to be mixed results, because the coking coal price went up very sharply, which will affect the profitability for current quarter, for Q4. Whereas the next quarter, in coming quarter, the results will see improvement. Chemicals, it is going to be mixed. Basic chemicals will do well. Basic chemicals means what I am referring is companies like Gujarat Alkalis, where they manufacture caustic soda, then GNFC, acetic acid. This type of company will show very good results. Whereas the specialty chemicals, they may see some pressure on their margins because the raw material prices has gone up. So chemicals, we have to divide into two. Basic chemicals will do well. Specialty chemicals, we will see some impact on their margin. Farm also, we are going to see mixed results. On cement, it is going to be mixed results, because January, February, the volume growth was lower, and March it was higher. But Q4, when last Q4, FY21 Q4 for cement, it was exceedingly a very good quarter for them. So they have to show the results on a higher base, or due to very high base effect, cement results also expected to be very bad. Apart from this, the big news we got in the last weekend was the huge merger of HDFC with the HDFC Bank. So HDFC has decided to merge with HDFC Bank. It is a reverse merger, just like how it happened in the ICICI Bank case. ICICI previously 25 years back, only ICICI was there, which was started as an institution, financial institution. ICICI then started ICICI Bank as a subsidiary. But when merger happened, ICICI got merged with ICICI Bank. That is, the parent company merged with a subsidiary company, which is called as a reverse merger. The similar thing also it has happened now. HDFC, which is the HDFC Bank, is the subsidiary of HDFC, but HDFC is going to merge with HDFC Bank. That is, parent company is going to merge with its subsidiary company, and that is why it is called a reverse merger. And post merger, HDFC will be delisted, and HDFC Bank alone will be there. And the ratio mentioned was for every 25 shares of HDFC, the shareholders will get 42 shares of HDFC Bank. And if you see the merged entity, it will become almost 17 lakh crore finance bank. Right now, HDFC Bank has a book size of 12 lakh crore, whereas HDFC has a book size of 5 lakh crore. And combined together, we will get around 17 lakh crore of 17 lakh crore book size of a bank, which is a very big one after SBI. It will become the second biggest bank after SBI. SBI has a book size of around 27 lakh crore. So the next one will become HDFC Bank, and the book size will be around 17 lakh crore. And the time taken for the merger, it will take at least 1 year to 2 years to get completed, because right now the HDFC has AMC, it has an insurance, both life insurance and general insurance. So they have to get a lot of approval from many regulatory agencies. They have to get approval from RBI, from SEBI, from some from IRDA, like that. So many regulatory approvals are there. Moreover, HDFC and HDFC banks are listed overseas also. So it will take at least 12 months to 1 year for the merger to get completed. So there is no hurry to buy HDFC shares or HDFC bank shares right now, because the merger will take at least 1 to 2 years to complete. Suppose if there is any sharp correction happens in the market, then you can start accumulating. You can start accumulating gradually, either HDFC bank or HDFC. There is no compulsion to buy the shares now because of the merger, because it will take at least 1 to 2 year time. You can gradually accumulate it. After the news came, many retail investors bought it. But if you see that Monday, the stock price went up very sharply. But immediately what happened was that in the subsequent 3-4 days, the stock price fell below the pre-merger rates. FIIs, they mainly sold it, which were looking for reason to sell. They got a good exit in both HDFC and HDFC Bank in the recent up move. This is the RBI repo rate. RBI kept the repo rate unchanged, but they have changed one important rate, which is the actually they should have hiked the reverse repo rate, but they did not did it. Instead of that, they brought a new rate called a standing deposit facility, which is nothing but if a bank has money, excess money, means right now what they will do is that they will give that money to RBI through reverse repo at 3.35%. Now what RBI did yesterday was that they brought a new deposit facility, which is called standing deposit facility, where RBI will give 3.75%. Repo rate is at 3.35%, whereas the standing deposit facility is 3.75%. That means 40 basis point higher for banks to deposit money in RBI for overnight money through standing deposit facility, which in turn indicate that the short-term rate RBI has hiked. In spite of keeping repo rate unchanged, which is more or less a long-term rate, they have untouched the repo rate, whereas short-term rate they have hiked it by 40 basis point indirectly through an instrument called standing deposit facility, which they introduced yesterday. That is why if you see that our bond market also reacted slightly negative to the RBI policy, where the bond yield crossed 7%. Moreover, RBI also told that in coming meetings they may remove the accommodative term from in their policy. Whereas if you see US Fed, they have hiked the rate. Only in 2019 was the last rate hike, but after 3 years, during COVID time they reduced the rate very sharply. Now again the rate hike have kick-started. From here on, for the next 5-6 meeting, it is expected that RBI, the US Fed, will keep on hiking rates. In every meeting, they will hike rates. In 1 or 2 meeting, in coming meeting, they may have possibility of hiking rate by 50 basis point. If you see that in 2017-18, actually US Fed hiked the rates. Similarly, the rate hike will happen in 2022 and 23. But there is a big difference between the rate hike happened in 2018 and 2022. In 2018, why they hiked the rate was that economy was doing very well. Inflation was manageable. Because of economy doing well, they hiked the rate. Whereas now the main reason was main reason of hiking the rate is the inflation is very high. So because of inflation, US Fed is now hiking rate. Whereas in 2018, the reason for hiking the rate was strong economy. So there is a big difference between the rate hike happened in 2018 and rate hike happening now. Actually, what market worries more than the rate hike is that the US Fed is planning to shrink the balance sheet by 95 billion a month starting. Most probably it will start from May onwards. Initially, the balance sheet shrinkage may be 30-40 billion per month, but it will gradually go to 95 billion a month in next few months from May. In last 2 years, when COVID came, US Fed, what they did was they did quantitative easing. That means every month they were buying US bonds from the market, almost 120 billion they were buying from the market. So whenever US Fed buying bonds means what they are doing is that they are actually injecting liquidity in the economy. Now they have stopped buying the bonds. Now they are going to reverse what they did in the last 2 years. Instead of injecting liquidity in the economy, they are going to suck liquidity from the economy. The last 2 years, they did almost 120 billion of liquidity injection in the economy, the US economy. Now they are planning to withdraw 95 billion from the economy. That means the reverse of quantitative easing, which is mentioned various terms. Some of them are telling that the term is called quantitative tapering. They are telling. Some of them are telling that quantitative tandem. They are telling. So many new words were used for this action by US Fed. But definitely it is a negative move as far as the valuations are concerned. Because whenever there is huge liquidity in the system, what used to happen is that the valuation of stocks used to go up. Because if I keep money ideal, I will get 0% interest or 1% interest. But even if I get 2%, 3% return from a stock, I will start buying that company because liquidity is abundantly available. Now, US Fed is going to suck out $95 billion worth of liquidity from the market, and which means that what will happen is that the valuations of many stocks, particularly those which are trading at very high valuations, 50 PE, 100 PE, and some of the startups which are showing huge losses, that valuations may get derated because of the Fed move. Initially, how Fed is going to do is that initially they will give matured bond. They will initially US Fed they will do it by bond maturity. Then later on, what they will use to that, they will start selling the bond. In the last 2 years, what they did was that US Fed was buying bonds, but now what they will do is that they will start selling the bonds, which means that money will come out of the system. So the main impact because of this US Fed move is that globally the liquidity will start coming, gradually start coming down. The second thing is that the valuation of stocks may get derated because of this Fed move. And this is the US Fed balance sheet. And if you see that it is now almost 9 trillion and now the US Fed balance sheet. And there has been a sharp increase in US Fed balance sheet since the COVID came, almost double. During the March 2020, the Fed balance sheet was for 4 billion. It went sharply to 6.55 billion, 7 billion. Then every month they did quantitative easing. It went up gradually. Now what is going to happen? It's going to, the chart is going to start coming down from May onwards. It will stay flat for the next two months. And from May onwards, it will start reversing and it will gradually come down. And it is expected that Fed wants to bring down the balance sheet size to around 6 to 6.5 in the next 2 years. By 2024, they want the Fed balance sheet to be around 6 to 6.5 trillion. That means that this chart will gradually start coming down. The trend will start coming down. And if you see the TV, Bloomberg or CNBC, US CNBC, one important term everyone is talking now is about US yield curve inversion. Many of them could have heard it. In simple term, what is meant by US yield curve inversion means, generally if you see the bond prices, there are various tenors of bond. Short-term bonds are there, long-term bonds are there, 2-year bond, 5-year bond, then 10-year bond, 20-year bonds, like various bonds are trading in the market. In a normal economic condition, what used to happen is that the small tenure bond, 2-year bond, 3-year bond, their interest rate will be lower, whereas the 10-year bond, 20-year bond, their interest rate used to be higher. But now if you see that 2-year bond of US as well as 2-year bond of a 10-year bond of US, they are trading at almost same yield, around 2.5. To 2 days back, both were trading around 2.5%, whereas yesterday, now the 10-year yield went again to 2.7. So whenever a short-term yield trades higher than long-term yield, for example, right now the 10-year yield is trading at 2.7%. Suppose the 2-year yield starts trading at 2.8%, means the short-term yield is higher than long-term yield. If that happens, then it is called yield curve inversion. In simple term, I have explained it, where what is meant by yield curve inversion means short-term interest rate will be higher than long-term interest rate. If that happens, means it is called yield curve inversion, which indicates that in short-term economy is facing some tough time, whereas in longer term it is okay. That's what it indicates. Historically, if you see that whenever this has happened, within 1 to 2 years of yield curve inversion, there is a very good possibility of US going into recession. And this is the chart for the last 70 years. So whenever the yield curve inversion has happened, the US has seen recession. For example, in 2007, in 2005, the yield curve has inverted. In 2008, we got a global economic crisis. We have seen. In 1998, which is this red, which is below the line red, that is called that is where the yield curve inversion happened in US. And in 1998-99, the yield curve inversion happened. In 2001, the US went into recession. In 1988, yield curve inversion happened. In 1990, the US went into recession. Like that, if you compare historically, whenever the yield curve recession happened, yield curve inversion happened, the recession was followed in next 1 year to 2 years time. So right now, the yield curve has come to yield curve inversion almost zero now. 1 week, 10 days back, 2-3 times the yield curve inversion has happened. Now again, the 10-year bond yield has gone up. It is almost at the flat level. Suppose if yield curve inversion happens continuously for a few weeks or a couple of months, then there is a very good possibility of US entering into recession in the next 1 to 2 years. That is what historical data indicates, and it will be watched very closely by big institutions in US, because they are the one which trade both in bond market as well as the equity market. And yield curve inversion happens, and if it stays for a couple of months, means definitely they will take some important decisions related to equities. And FII flows, they are in the continuous selling mode. One of the highest selling, 16 billion they have sold in the last financial year, thanks to our domestic investors flow through mutual funds and through direct participation. If domestic flows are not there, definitely our market would have fell by 20-30% very easily. But in spite of heavy selling by FIIs, our market did not correct much. Almost 16 billion, whatever we got in FY21, 50% we have lost in FY22. And this is a very interesting chart. What I shown previously was the financial year. Now this is the calendar year flow. And if we see that in the last full year, we lost around 16 billion. Whereas now, if we see that in the first 3 months, January, this is the calendar year flows. Among 16 billion we lost for last full year, almost 90% of it we lost in the January, February, March. That is 15 billion we lost it in the first quarter of current calendar year. And in that, the domestic mutual fund flows was 9 billion, which has managed, which has a balanced majority of foreign outflows. Apart from that, then domestic flows were direct inflows were there. Then we have institutions like LIC, which also bought a lot of shares during that period. That is why the damage to the market was very limited. And if you see that before that, only in 2008 calendar year, we had this much of selling by FIIs. 13 billion they have sold it in a, which is the largest flow in a single calendar year flow of 13 billion. At that time, market fell very sharply. More than 40-50% market fell in that year in 2008. But this time, the damage was very less, mainly because of the domestic flows. So on a conclusion, market, at least our domestic market, looking very positive. There are ample number of investment opportunities are available. Similarly, a lot of trading opportunities are available. Many sectors and themes are coming every week, and you can easily do trading, and always keep stop loss for trading positions, because trading, one should not take a long-term view for your trading opportunities. Once you have decided for a short-term miss, you have to keep it for short-term. If stop loss hits miss, then you have to exit the position. Only for investment, you should not keep stop loss, whereas for trading opportunities, always keep stop loss. And some of the themes where we are expecting a good up move in next 2-3 months. One is the defense, where already we have started seeing good move in the defense stocks. Yesterday also, a lot of defense stocks went up. Some of the stocks where huge momentum is there. Is the Bharat Dynamics, where huge momentum is there in that stock. Among large cap, BEL and HAL, Hindustan Aeronautics, both are in F&O shares, and they are doing well, and they will do well also in coming months. And defense as a theme will do well for the next say 6 months. And recently, many stocks were listed in defense space. For example, Paras, like that, many companies were listed. Data Patterns, it's also a defense related stocks. And you have to be careful on the valuations. And some of the stocks like Paras and all, we are not very happy with the valuations, because it is trading at extremely very high valuation. So we are not recommending for delivery. If for trading purpose, you can take it. For delivery, this type of very high valuation stocks, you should not take it. Whereas some of the stocks like Garden Reach, one of our old favorites, still we are very positive. Next 2 years, every quarter we are expecting that company to show 30% growth from here on, and we are expecting the stock price to go up by at least 50% in the next 1 year, because they have come to a crucial stage. Their project execution has come to a crucial stage where the execution will get speed up very, very fast, and the revenue and the profit recognition also very high. So we are very positive on Garden Rich Shipbuilders. BEL and HAL among large cap, we are very positive. For momentum trading, BDL, you can see it. Recently, the stock price has gone up very sharply, but we expect the momentum to continue in BDL and overall defense stocks. The other sector we are very positive is the agri stocks. Already we are seeing a lot of fertilizer stocks are doing well. We expect the momentum to continue in agri stocks also. Agri fertilizer stocks are there, seed stocks are there, then pesticide and insecticide stocks are there. All are expected to do well in the next 3-4 months. These stocks will do well. So both defense and agri related stocks, one can find investment as well as trading opportunity. And events to watch: LIC IPO. It is expected that in the month of May, government may come out with a LIC IPO. So that has to be seen. It is expected that around 50 to 60,000 crores IPO it is going to be. And for that to happen, market should be stable. Then only IPO will come. In order for the LIC government to float the LIC IPO, government will try to please the market in various ways. And the second important thing to watch is the result season, and the results will be crucial. We expect some volatility in many stocks and sectors may be seen during the result announcement time. So this is the presentation, and I will come out with the recommendations. So in this month, basically we have given the beaten down stocks. Stocks which fell very sharply from the peak, and still fundamentals are relatively good. These are the in that way we have selected recommendation in current month, and you can see that Nifty is just to 4-5% away from high, but still many stocks are down by 30%, 40% from the peak. So our selection for current month is basically related to the beaten down stocks where there is a possibility of bounce back happening. So the first stock we are recommended is a Godrej Properties. It belongs to reputed group, and what we are hearing is that real estate as a sector is doing very well, and Godrej Property among large cap is one of the company which is consistently doing well in the real estate space. And if you see that from the peak, the stock has corrected by almost 30-40%. One reason why it fell very sharply was that the company 1 month back, the company decided to invest some money with a joint venture with a company called DB Reality. So DB Reality don't have a good name in the market because of various corporate governance issue. So when Godrej Properties did a tie-up with them, market did not like it, and the stock price fell very sharply. They very negatively reacted to that, and finally Godrej Property decided to cancel that joint venture with DB Reality. And now many projects are Godrej Properties are announcing it, and it is one of the pan-India player. And if you see majority of real estate companies, they are mostly concentrated on few areas, and Godrej Properties is one of the pan-India company, and one can buy. The second company which we are recommending is the Dalmia Bharat, and it is a fourth largest cement company in India. That first one is the Ultratech, then we have Shree Cement, then ACC Ambuja, then which belongs to the same promoter, ACC and Ambuja, which it belongs to Holcim, which is an MNC company. And first one is the Ultratech. They have a capacity of 120 million tons. Then we have Shree Cement, then ACC Ambuja, followed by Dalmia Bharat. It is the fourth largest cement company. It currently has around 35 million tons of capacity. They are going to increase to 48 million tons in the next 2 years. If that happens, means their capacity will come in line with Shree Cement. That is, they will become the third largest cement player in next 2 year time. Their capacity will become near to Shree Cement. And one important thing I like about this Dalmia Cement is that they are focusing on ESG. That means they have started using more green energy. They have started using waste material for production of cement, and it is the lowest carbon dioxide emitter of globally among all cement company. So the lowest CO2 emitter, and it is focusing on green very aggressively, and they have plans to become almost 100% green energy user in 2040. And currently worldwide, if you see companies which are focusing on ESG, they are getting high valuation. And what we feel is that next 2 years time, if their capacity goes to 50 million tons, means we expect the re-rating to happen. And right now it is trading around $120 per ton valuation. And once it becomes a 50 million ton capacity, means we expect the valuation re-rating to happen by around 30-40%, where the valuation go to around $150-170 per ton. The third one is the stock we are recommending is the Piramal Enterprises. The Piramal Enterprises, the company has two divisions. One is the financials, and second one is the pharmaceutical. And company has already decided to demerge the pharma division into a separate company into Piramal Pharma. That process is going on, and we expect in the next 6 months to 1 year, the shareholders of Piramal Enterprises will get shares of Piramal Pharma, and PEL will become a pure financial company. Last year, they took over this a bankrupted company, Diwan Housing, and they increased the book size because of the takeover. And previously, they were mainly financing to real estate firms. Now, because of takeover of the Diwan Housing, the company has entered into retail financing also. And we expect the demerger of the company will be value accretive, and one can buy with a 6 months to 1 year view, keeping a demerger in mind. The fourth stock we are recommending is a Coromandel International. As I said previously, the agri as a theme is likely to do well. Coromandel International is the second largest manufacturer of phosphatic fertilizer. See, the fertilizers are of two types. One is the nitrogenous fertilizer, which is basically the urea. The second one is the phosphatic fertilizer, where mostly phosphates are used for that. And Coromandel International is the second largest producer of phosphatic fertilizer in our country. The first one is an government company. The second one is the Coromandel International. And some of the products they are manufacturing are don't have subsidy. That means their products they have independent to sell at any rate they want, and for subsidized products they will get the subsidy from the government, where they are not allowed to hike the rates, whereas the non-subsidy products they are allowed to sell the rates according to the movement in raw material prices. The second important thing why we like Coromandel International is that they have backward integrated for phosphoric acid. That is one big positive for them. The other thing is that they have stake in overseas company for the raw material security. They have stakes in two companies where they will buy the raw material from them, and which will give them some security on raw materials in the current very volatile time. Right now, the raw materials for fertilizers are very hard to get because of the Russia-Ukraine issue. And since this Coromandel International has stake in two companies overseas, a part of the raw material for them is assured. And moreover, it belongs to Murugappa Group. It's a very reputed group, and one can buy Coromandel International with a medium-term view. And the last company which we are recommending is the FSL, which is basically a BPO company. As I said previously, it is also one of the stock which corrected very sharply from the peak. It went up to 235. Right now, it is trading at 135. The company generates decent cash, and part of it they are giving it as a dividend, and one can buy a FSL for a decent return. So overall, this time I have given stocks where the prices has fell very sharply. Godrej Property fell from 2,600 to 1,600. Similarly, Dalmia Bharat, if you see, the price fell from 2,600 to 1,600. Piramal from 3,000 to 2,300 now. Coromandel, it was a range bound for the last 1.5 years. Anytime the breakout can come and one can buy it. The FSL from 230 level, it has come to 135 level. Valuations have become attractive now. And previous month review, if you see that BEL has done very well, and if you see that it has given almost 12% return. Hindalco, after we gave recommendation, it went up very sharply. Now it has corrected, and Zydus Life also is range bound after our recommendation. One can accumulate and can hold it. And Balrampur Sini, if you see that after our recommendation, sugar has seen very good activity, and post our recommendation, it went up to 525. Still, it is in positive. So overall, our stocks has given 4% return in the last 1 month. Whereas Nifty, it has gone up by 7%. And now, a few more charts are there, and please be online. Patnaban will take the charts now, technical opinion on the market.
Good morning to everyone. We will see 3 charts of Nifty levels. The previous month, the Nifty was trading within a downward channel. This is the downward channel. After the touching 15,650, now it is trading inside an upward channel. So Nifty is getting support inside this channel. As long as the Nifty holds this channel, it's positive. The market will go up only. This is the support level of the downside trend line is the support level for the channel. If it's break this upward level, then market will be more bullish. This is the Fibonacci retracement level lines. As per Fibonacci retracement line, the market will move higher because it is trading above the 61.8% of the recent fall. The recent fall was drastic from 18,000 to 15,650. So now it's moved up to 17,800. So it is trading above the 61.8% of 17,450. Unless it breaks 17,450, the market will be bullish. So 17,450 is the strong support for the market in near term, and the market will remain bullish and supposed to touch new high in the short to medium term when it's trade above 17,450. These are the support and resistance for the market. The immediate resistance is 18,100, then 18,350 and 18,600, which is the all-time high. So one must watch 18,100, 350 and 600 for the resistance level. Support level is immediate is 17,650. 17,650 is the immediate support, and the next level is this one, which is coincide with the Fibonacci retracement level of 17,450. So 17,650 and 17,450 are the immediate supports, and the market will trade sideways to positive side in the near term. And these are the 3 charts. The market remain bullish in the near term.